Well, hello, everybody. My name is Ben Rhodes. I'm the Senior Vice President with CAMS. Thank you for joining us today. Got an exciting presentation talking about community association financial reporting. With us, we have Adam Beaudoin, Amy Wooten, and Chuck Earney to help lead us through this discussion. I'll turn it over to them in just a second. As a reminder, we do record this video, and we do hope that you will share the information that you learned today with your other board members. The recordings are hosted on our website, camsmgt.com, under the board member resources page. And so we have a lot of great recordings there for you to visit, and we hope you will please check those out. We will be using the Q&A function. So if you do have questions, please feel free to type those questions in the Q&A section located on the Zoom toolbar, and we'll help facilitate those questions towards the end of the presentation. So again, thank you for joining, and Adam, I will turn it over to you.
Ben, I really appreciate it and appreciate CAMS putting this together and allowing us to present. I'm delighted to be presenting with my law partner, Amy Wooten, who you see is fancy because she is licensed in both North and South Carolina, and one of my good friends, Chuck Earney, who we've worked together for 17 years. It's hard to believe that when I first met Chuck, he was, in addition to full-time accounting and that whole business under his name, he was also a professor at UNCW. So really happy for you all to join us. I'm going to walk you through this very exciting topic of community association financial reporting. And our goal is to leave enough time at the end to answer those questions. So without further ado, let's start working through these slides. I'm going to be the first one. So Ben, if you want to advance it, the first topic is going to be North Carolina, and we're going to talk about what types of records a homeowners association, condominium owners association has to keep in North Carolina. So just very quickly, there's two statutes in North Carolina, one that deals with condominiums, and a condominium is essentially a creature of statute, which is horizontally stacked units on top of one another, and then a planned community, which essentially is everything else, your townhomes, your single family homes, things of that nature. And so we get a lot of guidance from our statute where it says the association shall keep all the financial records sufficiently detailed in order to enable the association to comply with this chapter. So I get all the time, especially during budget season, what does this mean? And so what this means is that no matter what kind of association you are, whether you're incorporated, unincorporated, you must keep accurate records of all cash receipts and expenditures and your assets and liabilities, anything that your bylaws require, which can be fun, especially when they say all financial records, right? Because what is a financial record? Well, the financial records are exactly what the statute's going to tell you they are, which are your cash receipts, your expenditures, your assets and liabilities, balance sheets, and expense statements. And so your members are entitled to see the balance sheet and income and expense statements within 75 days of the end of every calendar year. And that doesn't mean you have to necessarily provide them and send them out, but you can either put a link on your website, or if someone asks for them, that you have to let them know that they're available and they can inspect them. So let's go to the next slide here, Ben. So this next one deals with what are the member inspection rights for keeping those accounting records in place. And so we've already talked about the annual financial statements, which are that balance sheet for the end of the year. And that makes sense, right? Because the members need to know where their money is being spent, how much money are potentially in their reserve accounts as you look forward to the next year in terms of your planning. And so if you have financial statements that are reported by a CPA, then you need to include their report with the financial statement. If not, then you have to have your president basically state that they were prepared according to generally accepted accounting principles or practices, and that if there's any differences from the previous year, those have to be enumerated. This is a great reason why you should have a CPA preparing your financial statements and not do them in-house. It's going to keep you out of some trouble here. So now we're going to talk about audits. So Ben, if you don't mind, we'll hit the next one. So in North Carolina, there is no statutory requirement that an association have an audit. There have been over the years bills that have popped up in the legislature that might require an audit. It normally happens during an economic downturn, and it normally would happen sometimes when you've had a story through the state that where a management company or somebody stole some money or things of that nature, where it's been sensationalized in the news. But right now there is no requirement at law that you have to have an audit. And so the place we look to see if your community needs to have an audit would be, what do the governing documents say, right? Do your governing documents require you to have an audit? If so, how frequently? What level of audit? And when Chuck speaks, he can talk about the different levels there are, reviews versus audits, etc. And so the good news, though, in North Carolina is that even if your documents are silent, if your board doesn't want to have an audit conducted, then the members can actually petition and require the board to get an audit, right? And so they could ask for a compilation, a review, and an audit, and each of those levels of review are much higher. And the main goal you want is an unqualified audit. That's what you'd like to receive, to give your members the peace of mind that they have elected you to the board and that they've spent your money wisely and they're managing the affairs of the association. Okay. And so that's something that you can always do. And it's only a majority of the members that need to have that happen. And if you have a majority of the board that decides they want to do it as well, they can. Audits are not inexpensive, but they're very valuable, especially if your community has a lot of money under management. In the old days, we used to say maybe $100,000, but now it's probably a little bit higher, somewhere between $250,000 or maybe $500,000. And so we're happy to answer questions about that. And then finally, let's move on to the budget in North Carolina, right? It's budget season. So I talked at the beginning about the difference between condominiums and planned communities a little bit. And so here's one of the places that the statute deviates between the two. The statutes are the same, as I mentioned at the beginning, in terms of what records and financial records an association has to keep. However, when it comes to budget and budget season, if you're a condominium, it doesn't matter when you were created, you're going to have to go through a budget ratification process. And I'm going to explain what that is in just a minute. If you're a planned community, that is a single family home, custom home, patio home, zero lot line community, townhome community, unless you were created on or after January 1, 1999, you don't have to ratify your budget unless your documents require some type of approval or ratification. And so what is ratification? What it basically means is that the board comes up with the budget, and within 30 days of creating that budget, they need to notice and call a meeting of the members. That notice is no less than 10, no more than 60 days. And the purpose of that meeting is for the board to explain what the budget is going to be, but primarily it's what the assessments are going to be for the upcoming year, so that people can budget, the association can budget. And whether your assessments are monthly, quarterly, annually, doesn't really matter. The board is the one who's going to make that decision, but it's the amount that's critical. So what the law says in North Carolina is that unless a majority or a higher number, if it's in your declaration, I've seen somewhere it's 75% or 80% to reject the budget, unless a majority of the entire membership, and that's important, not just the people in attendance at the meeting, vote to reject the budget, it's automatically ratified. And the reason this is so important is because most of the time with our communities that we represent, and we represent well over 600, on average, we never have a majority of owners actually be in attendance at any meeting, whether virtually, whether via proxy, in person. It's very rare that you have that many folks in attendance. Now, normally what you'll have is either 10 or 20 or maybe 30% so that you hit quorum, but the majority, the overwhelming majority, I should say, of members in a community association, especially the bigger it is, aren't going to attend the meeting. So the likelihood of a budget being rejected is small. And that means that if you know at the start of a meeting that you don't even have a majority in attendance at that meeting, you know before you even present the budget that at law, it has been ratified. And finally, if you call the meeting and you don't even get a quorum, the budget has also been ratified at law. And so keep in mind that it's not an affirmative vote. We're not saying, hey, is the budget approved? When you stand up and present the budget, you say, hey, are there any questions? I usually count to 5 Mississippi in my head. And after that, I'll say, hearing no questions, no motions, the budget has been ratified. And you move on. I don't call for a question. I don't call for a vote. I just move on. I've been doing this 21 years. I've only attended one meeting, and I've attended probably tens of thousands, where the budget was failed to be ratified. And it was 3 years in a row, and it was the same community. And they were in a fight with their board and with their developer, and it was an ugly situation. And their goal in rejecting the budget was to try to put a stranglehold on the legal dollars that the association could spend defending litigation against the members. So that's the story in North Carolina. And now here's a peek out of the South Carolina window. Amy?
And a short peek it will be, as South Carolina law is even less defined and detailed than North Carolina on this particular topic. Like North Carolina, though, South Carolina does have statutes that are specific in the single-family homeowner association context, and also in the context of the horizontal property or condo association context. So we'll spend a little bit of time talking about both of those. South Carolina Homeowners Association Act, which came into effect in 2018, provides an avenue for homeowners associations that are not otherwise subject to South Carolina's Nonprofit Corporation Act, a way to incorporate and access some of the provisions of that Nonprofit Corporation Act that are specific to record keeping and access of owners to get those materials. So in particular, the Homeowners Association Act through Section 273150 provides that the sections you see before you in Chapter 33 are going to apply. Those sections apply to nonprofit corporations, and they also apply by virtue of this statute to homeowners associations that are not organized under South Carolina's Nonprofit Corporation Act. So Ben, if you wouldn't mind advancing us to the next slide on that. Gotcha. So we'll spend a little time diving into the specifics of those statutes that are part of the Nonprofit Corporation Act. There are several of them here that provide rights to members. 33, Section 31-1602, for example, that one is going to give members the right to inspect certain accounting records of the corporation, but that's a qualified right. The members do have to meet the requirements of the statute in order to have that inspection right. They have to have a good faith and a proper purpose for making the request to inspect those records. They have to, in fact, inspect them for that particular purpose. And the records that they are asking to inspect have to be directly connected to the purpose for which they have made the request. South Carolina's Homeowners Association Act also does provide a little context for how the records are supposed to be kept. If you are a homeowners association subject to South Carolina's Homeowners Association Act, then the statute provides the board is required to keep a book, and it's supposed to have the details of account in chronological order. And those receipts and expenditures that relate to the administration or impact the property within the association are supposed to be maintained in that book. It's supposed to have sufficient detail to allow for giving indication as to what maintenance or repair expenses were incurred for common elements or other expenses that would fall to the association. And that book is supposed to be available for inspection by owners on working days, essentially during working hours that convenient hours can be set by the board for that. But they are supposed to have those hours published so that owners will know when they are able to have that inspection of those books and records. Ben, if you could advance us, thank you. South Carolina does not have a lot of context for annual budgets or requirements, less than North Carolina. The statute does talk, though, in terms of what notice needs to be given before a homeowners association can take action to increase the annual budget. And the statute specifically requires advance notice of at least 48 hours. It gives some guidance on how and where that notice can be posted. But a quick caveat to this statute and this 48-hour advance notice requirement is it does not apply to HOAs that are incorporated under South Carolina's Nonprofit Corporation Act. The Nonprofit Corporation Act itself does not address budgets or how budgets are managed, but will have some guidance on meetings and notice requirements generally related to that would come into play in the context of HOAs that are incorporated under that act and therefore not subject to this 48-hour requirement. Ben, if you could advance us, please. Right. And real quick, a note that I just wanted to make on the horizontal property statute. That is the one that talks about the records of receipts and expenditures. I think I mentioned that was the HOA, but that was my error. That is the Horizontal Property Act that applies there. And that makes sense, right? Because the association that's a condo association is going to have a lot more records related to common elements and expenses. So that statute applies in that context.
Yeah, essentially what Amy's saying is the Horizontal Property Act in South Carolina is the equivalent of what we have as a condominium act. And if anyone's ever been to Myrtle Beach, they know there's a lot of condominiums, there's a lot of golf courses, it's a resort area, right? So a lot of people invest and purchase what we've heard called timeshares, things of that nature. And so there's a lot more ability for owners of an interest in real property or a condominium unit or a timeshare to get the information about the maintenance, about the financial records and things of that nature, which is very different than up until 2018. If you were in a homeowners association, especially an unincorporated one, you had no ability to really get anything. It was whatever your documents said. And so I joke all the time. And keep in mind that although Amy is fancy and she is North Carolina, South Carolina, she's up in Raleigh, that South Carolina is a bit of the wild, wild west compared to North Carolina because the statutes are just not as robust. And we were joking about it before, the fact that, oh, if you're a nonprofit corporation, homeowner association, oh, you have no budget requirements at all. You don't even have to give your members any notice of that at all. It seems a little ridiculous. I would hope that the governing documents would provide a little more clarity to the owners. And speaking of clarity, you guys are in for a treat because Chuck Earney is up next and we're going to go away for a little bit, but we're all going to come back and reconvene for questions.
Adam, you set me up. I'm an accountant, and accountants are supposed to be boring. And we like to spend our careers presenting boring information with nothing exciting. And no one likes a entertaining, surprising, complicated audit with lots of problems. And nobody likes to have to call a wonderful firm like Ward Smith to get you out of problems. I love all you guys out there today. You are phenomenal people. I think a famous cook said, I love people who love to eat. I have a great appreciation for those of you volunteers. The last time I checked, I don't think there was any budgeted payroll for any of you folks on the board. So you're volunteering out of the goodness of your heart, and you're hoping to have some warm fuzzies from the job you do. A homeowners association is one of the toughest areas to get back those warm fuzzies, because you're dealing with people's homes. They're very emotional about them. They have lots of issues. So it's hard. And so I empathize very, very much with all of you who are volunteering your time today to see this and are volunteering your time to be on a homeowners association board. Your neighbors should deeply appreciate you. I've been in this business 40 years, and I've been president of a commercial HOA and a treasurer of a condominium association, which had a $6 million hurricane loss and had to have a special assessment because of some builder's defects. It was lots of fun. It was a very difficult situation. So you need a CPA. You need a CPA to help you through so many issues that you may have to deal with over time. And we're your trusted advisor to be there. You're in an industry that's very peculiar as to accounting and as to rules. And it's helpful to have the support of a CPA with experience in those areas that you can trust. The first thing I would tell you from the accounting overview perspective of a firm or of a HOA is the first thing you need to do is have a management company. And the reason I say that, the discussion earlier here was about detailed records and what accountants would translate as a general ledger. Transactions all laid out that you could look at if you wanted to, all supported, and a third-party property manager like CAMS presents that information. You can depend on them to do it. They're your accounting department. There's a lot involved in accounting for an HOA. The great thing, so have a management company. Also, their job is to help you with your fiduciary responsibility, those things that Adam and Amy talked about for annual meetings and budgets, and all of those is part of the standard operating procedure at most management companies like CAMS. And that's very important for you to know, that their job is to keep you on track. Our job as CPAs is to help you with your fiduciary responsibility. And I'm going to talk you through some of your responsibilities from the point of view, big picture of a CPA. What are your really big picture responsibilities, practical responsibilities? We as CPAs focus on economics, and you will be so glad that when you're able to only focus on economics, because emotions and politics are a huge part of what an HOA board has to deal with, but accountants focus on the economics. And the first economic piece of advice I will give to every board, which I always do, is you almost always must have annual increase in assessments. One of the worst things you can do is say no increase this year, and you get about the same amount of joy out of your neighbors as giving a 5-year-old an ice cream cone. And an hour later, they forget it. But tell those neighbors in a year or two that you can't afford the insurance and you have to raise your assessments 10% to make up for the 2 or 3 years you should have raised them 3% or 2%. Not a good idea. So you can blame your CPA for that advice, but I think it's good advice. Our job is to protect the overall HOA, to advise boards on what to do to protect the interest of the overall interest of the HOA. Well, every CPA, why do you need a CPA? Most of you will say, well, we got to file a tax return. Okay, true. And there's hardly anything as complex, believe it or not, as the tax laws for HOAs. Where else do you get a choice of which form you're going to file? Nowhere else in the tax law that I know of, you get to choose. And you get to choose a short form, but it's got a higher rate, or what we call a long form, corporate form, which has a lower rate, but it's much more complex. You need somebody to guide you in making that decision. It is crucial. The short form, briefly, is only for residential. You can't use this if it's commercial, if it's a commercial HOA. It requires you to spend 90% of your assessments every year. The idea of this form is it only taxes what a homeowner would be taxed from their home. So for example, you put a new roof on your house, you can't deduct that. You mow your lawn, you can't deduct that. Similarly, the H return is designed that when you collect assessments and you use them to make repairs or manage and operate an HOA, like operating your home, the money you bring in, the assessment, and what you spend is neither income, taxable income, or deductible. It's just exempt from tax, which is great news. But if you save some money as a homeowner and you put it in an investment account, because you're going to put the money in an account for a new roof, and you make interest, well, maybe we'll start making a little more interest that it'll really count. But if you make any interest, you have to pay tax on that interest. We all understand that. Same thing with an HOA. If you earn income on the investments you have to pay tax on it. It's taxed at around 30%. Or if you get inside businesses. So you rent out your clubhouse to anybody who might want to come and use it, and you have members from the community come and use it. That's considered like renting your house out to the movie studio. That's considered other income, and it's reportable on this form. You can deduct expenses. So the great thing about 1120H is it is simple. It's a one-page form. It's the only form in my understanding of the IRS that they require it to be paper filed, which is really unusual for CPAs. We have to electronically file everything else, but it has to be filed paper, and you have to qualify it. have to spend 90% of your assessments every year. You cannot have more than 40% of your income for non-assessment. Very low risk of audit, great little form, good choice in most cases. The other form is a long form, has to be used if you have a lot of commercial activities. So one of our clients is Landfall HOA here in Wilmington. They do a lot of services for their residents. Under this form, that's considered member income. It's part of what you can do for a member. But if the landfall does work for anybody outside their community, their gated community, and would use their landscaping service outside the community, they would have to pay tax on that. In the long form, it's a lower rate. It's 21%, much more complex to do because you have to analyze everything as to member income versus non-member. And so your CPA is probably going to charge more for that. So that's the tax return. You have to make that choice. The biggest thing with the long form is that you have to be very careful about how you handle your reserves. They have to be handled according to the way the IRS wants you to handle them. And that means you have to have a reserve study, you have to assess based on the study, you have to keep the money separate and spend it only for qualified items when you spend it. Why is it a big deal? Because if you properly handle it, the taking in that money is non-taxable. It's like a capital contribution. For those of you that might have had corporations, it's non-taxable. The bad news is if you do it wrong, imagine an IRS agent looking at your $1 million capital reserve that's in cash investments and saying you're not properly handling it. They have $1 million pot of cash that they could disqualify, and right there it's cash. They don't even have a collection problem. So that's one area you got to be careful with the long form. That's a fiduciary responsibility for boards for handling reserves. Don't mean to scare you. Good CPA can handle this. So next slide. Financial statements of an HOA. Nobody knows who the church lady is, but I do. I'm that old from Saturday Night Live. And she would say, isn't that special? Well, all the accounting for an HOA is special. Requires specialized skills of financial statement preparation and understanding the accounting for an HOA. Common property for sophisticated folks on boards drives them crazy because they say our biggest thing we got to take care of is our clubhouse and all our common property, and it's not on the balance sheet. What in the world is going on? Well, from a CPA perspective, we look at your common property more as an obligation of the board to take care of, and it's really not an asset. It's like the same accounting is used in museums for an art collection. It's not an asset, it's a responsibility. And so we normally don't show common property on your balance sheet for that reason. But what we do want to see as CPAs, and it's required in our financial statements, and it's not in your ordinary monthly books, is a required disclosure of your reserves and the reserve requirements. So CPAs require any CPA prepared financial statement of an HOA to have a reserve study supplementally disclosed. And that has to show what it's going to cost to repair or replace anything under your responsibility, normally in the next 20 to 30 years. Why is that important? Well, the reserve study, engineers estimate how long things are going to last. And the study says, okay, you're going to need this amount of money over the next 20 to 30 years to cover that. So in my condo association, we had a hurricane and the roof blew off. And the insurance paid for the whole thing. And so some of the residents says, well, release all the money in the reserve. We didn't have any money in the reserve because it was designed to be replaced 25 years out. And we covered it, had insurance for it, which was a smarter thing in this case in hurricane area. But we hadn't reserved for the roof. And imagine trying to collect enough dues to replace the roof for the next 20 years, charging residents now to replace it in 20 years. Can't do it. So the financial statements require the reserve study. Part of that is what needs to be replaced. Part of it is how much cash you've set aside to cover that responsibility. And that's important information for you to have. With the price of homes, more and more people are asking for the financial statements of their HOA because they don't want to buy into a place that's going to have special assessments or is under reserved. The other thing that's in the financial statements that's special is we always, at our firm, always include insurance coverage. It's not a requirement that most CPAs disclose, but the next best thing, as I've indicated, to the reserve study and setting aside cash for repair and replacement is having insurance when stuff happens that you never could have anticipated. Now, everybody needs to have wind and hail and hurricane insurance because that's become a normal event, considered normal event in southeastern North Carolina. So I think your residents would want to know what kind of insurance coverage you have on your property or replacement property. Next slide. So CPAs, when we do a financial statement, focus on assurance. We give you relative assurance that all the numbers are right. When you get a CPA-prepared financial statement, the 3 different levels of work we can do are based on the level of assurance we're given on there aren't any material errors in this financial statement. A compiled financial statement by a CPA will normally have, a balance sheet and income statement, a cash flow statement, and footnotes describing insurance, accounting principles, and the reserves. So that's a compiled financial statements. CAMS does very good monthly financials to help you manage your budget to actual and so forth. But the year-end's financial statement is designed for the big picture. How did you do for the whole year? And how's the board doing in responsibly setting aside money for reserves and so forth? A compiled financial statement has all that information in it. And a good CPA knows how to gather that information, put it in the right format. It looks like every other financial statement, except when you read the opinion, we have prepared it from the books and records. We have not audited it. We have not done the extra work of assuring that all the numbers are right. If you want some assurance for your CPA, we have a more costly but very cost beneficial type of engagement called a review. Now, CPAs that do these reports are experienced in working with HOAs, and so they review your financial statement against current accounting standards. They review the financial statements like a good businessman would review your financial results. They compare the results to budget. Does it make sense? They do various analytical steps, which is easy to compare. A well-run HOA to budget tells you an awful lot about the year. Probably as part of a review, we would make sure cash was reconciled and some fundamentals were done, but we're not required to do all that. And I'll be honest, a good accounting function like CAMS has would do all that and would be readily available for a board to review. So a well-run board would do a lot of this analytical work on their own, but it's independent. It's a third party that based on their experience and our integrity, would give you the information. Then there's audits, and that's the term that gets thrown in the mix. That's the highest level of CPA prepared financial statement assurance. An audit, you do everything we just talked about. You do the prepare the financials, you do the analytical, but then you get deep into it. Audits are custom designed based on an understanding of the controls, the board involvement, the IT controls in particular in an organization, how transactions are processed. So based on an understanding of how the organization is run, we design an audit. There are custom required steps that we have to do based on the AICPA standards. You have to confirm all your cash accounts and verify that all the cash that you say is on your balance sheet is actually at the bank. We do that directly with the bank. We test transactions. We walk through your IT function and make sure there aren't any glaring deficiencies in it. And if there are, which has been the case not with CAMS, but some of our other clients, we find deficiencies, we point them out, and the board needs to know about them. And we do much more verification. So those are the three levels of service. In most cases, for a St. James, for a landfall, for those large, like Figure 8 and these large HOAs, their board is responsible for large budgets. And of course, if you're on one of those boards, you want some final sign off on the year, and you want a CPA to do an audit of your financial statements. And it's cost beneficial. It makes sense for those type HOAs always to have an audit, and they do. For someone under $1 million budget, you should more likely look at a review or a cycle. 2 reviews or review audit is a very common cycle we do, or at least a audit every 3 years and do compilation review in between are options that I often see, because CPAs are cost beneficial. We don't want to feel like we're just milking it by any stretch of the imagination. We are very busy, have plenty of work to do. So we want you to see the cost benefit of the work we do. So that's sort of my general guideline. Over $1 million, definitely should seriously look at an audit. If you're between 500 to $1 million, a review, and under 100,000, you definitely would cost benefit. It's hard to justify one for a small budget like that, other than a compilation. So again, I commend all of you participants. I don't know how I am on time. Oh, I can go another hour and a half, but so I think I'm ready to open up for questions, Ben, if that's what you want to do now.
Yeah, excellent. Thank you all for helping guide us through that information. First question, I guess, for Adam or Amy. So if our covenants require us to do an audit every year, and Chuck just commented on maybe a different term, how should we handle audits if we don't necessarily have the budget to do them?
I'll jump on this grenade. And, you know, Chuck, I did appreciate your reference to Dana Carvey as the church lady from SNL. So I'm with you.
I'm amazed. I'm amazed. Okay. Thank you.
So I think what Ben's question is really, your documents say, your governing documents say that you're supposed to have an audit every year, and you haven't been having an audit. Is that correct, Ben? Is that basically?
Yep.
Right. And for whatever reason, either people have failed to read the documents, laziness, or the fact that they can't afford it. What I would say is that you need to probably amend your declaration. That would probably be the best place to start, or the bylaws, or wherever it is get that done. And I know you're probably out there in virtual land saying, but Adam, it takes a lot of effort and critical mass to do it. Can't we just keep doing things the way we've been doing them? And the answer is, well, sure, if you want to get your behind handed to you when you get sued eventually down the road, right? Because when you're a board member, and Chuck talked about the fiduciary responsibility, the board of any community association has 3 fiduciary duties: to act with good faith, due care, and loyalty. And the loyalty runs to the association itself, okay? And what that means is that if you disregard something that is blatantly in the document that's in there, and you just don't do it, that's what's called willful misconduct or an intentional act, which means there is no insurance for that to defend you. There is no insurance. There is no protection, right? It is, you're out in the breeze without any protection. So what I would say is, let's go ahead and amend it. If you can't amend it, then what you need to do is you need to comply with your governing documents, because failure to do so is going to get you hamstrung. There is no way to even go to the members and say, hey guys, hey gals, we're supposed to be doing this audit thing, but y'all don't want us to spend that money, right? Wrong. They can't, the members cannot set you free. So anyway, that's not the answer probably anyone likes to hear, but it's the right answer.
And I would interject that when you amend your bylaws, that you amend them to say CPA-prepared financials, which my understanding, just to be clear about this, is I love attorneys, but they're not accountants. And a lot of those wording got in the old bylaws 40 years ago sometimes. And that was just understood, that's what CPAs do. Well, we have different levels of service, and having an independent prepared financial is a huge part of this fiduciary responsibility. So I think having the CPA prepared financial statement that has the reserve information, the cash, the insurance information, anything necessary that a outside third party would need to see would be how I'd suggest amending the bylaws if you're doing it. Would you agree, Adam?
Absolutely. Yeah, I want to stay in my lane, and I like you to stay in your lane and work together.
Well, yeah, of course.
Okay, next question. I guess maybe for you, Chuck. Generally accepted accounting principles. Can you talk briefly about how CAMS financial statements comply with generally accepted accounting principles?
Well, the biggest thing would be they follow, and I know it's a horrible term, accountants have terrible terms, accrual accounting, which means that when a bill comes in for stuff that happened, you record it, not just when you pay it, but you record it as it happens. And you estimate bad debts. Part of generally accepted accounting is you look at your receivables, and there are no HOA I've ever known, and I've had arguments about this, has not had a bad debt ever. And if you haven't, good for you. But so accountants know it's going to happen, and you need to estimate it. That's generally accepted accounting principles. So those would be the biggest generally accepted accounting principles, combined with having to show a study, reserve study. That's a generally accepted accounting principle that you have to do or are supposed to do in a GAAP prepared financial statement. If you're keeping money in different buckets, we call them, there are other ways to reserve money. You have to use fund accounting. So those are some generally accepted accounting principles that an HOA has to deal with that are not on QuickBooks. That if you're doing a QuickBooks kind of report, you're not going to have all that stuff, most likely.
So kind of follow up to that question is do the monthly financials that CAMS produces comply with GAAP?
Yes.
Okay.
Absolutely. I mean, I'll keep it. I'm sorry. My son always says I talk too much, but sometimes it's best just to say, yes, they do. And I'm on record of that because I work with a lot of CAMS clients and I see it all the time.
Okay. Well, thank
and
you.
Once in a while, accountants have technical differences, but that's normal.
Okay. Amy, maybe next question for you. You talked a little bit about South Carolina's requirements to keep a book. If the information is stored online and made available to the residents online, does that satisfy the book requirements?
I don't think it does. The statute is written in a way that would contemplate a physical document. Now, I think if you've got the physical copy of the document, but you're also making the records electronically available, well, that's a different matter because you're meeting the requirement of the statute to have the book that needs to be available in accordance with the statute, but you also have those records in a different format. So my take on it would be it does not if you only have them electronically available, but are not maintaining that physical book as contemplated by the statute, at least as it currently exists.
So is the recommendation, if requested to see the book, we would need to print that information off for those individuals?
So in that instance, you don't have the book, so you're already not in compliance with the one statute. If it's a record that they're entitled to get that would otherwise be in the physical book, then I would make it available to the person. If it's available electronically, but for whatever reason they're not able to access it, then I would make it available in physical copy in the office. I don't think the statute would require, or the spirit of the statute would require you to print out and make available numerous copies for any owner who wants to come by and get that.
Okay. Adam, I see you shaking your head.
Yeah, no, I'm in agreement. I don't think that I think Amy's dead on. I think that it's a book in South Carolina based on the statute that you come to the office and you look at the book. It does not mean that we have to print out a copy for you to take with you. North Carolina is different that way. But South Carolina, it's like, hey, here's a physical book. If you want to come in and look at it in the office, you can. You're not allowed to make copies of it. You're not allowed to take it out of there. If you want an electronic copy, here you go.
Okay.
I would caution if you're going to have the electronic copy as a supplement to the book, it's very important to make sure that it matches the book. so that you're not creating confusion with having records available in one place that don't match what are available for folks to come into the office and look at.
And you want to keep that, those electronic copies. I think maybe that's why Chuck's raising his hand, is the integrity of those things, so they can't be, for lack of a legal term, messed with, right? That you have security protocols and things of that nature where they can't be edited at all. Because nefarious owners, they want the narrative to be whatever it is that they're saying, right? And so they will, it's not above or beneath them to make adjustments.
Mm-hmm. Chuck, you had a comment?
Yeah, I just have to make two anecdotal comments. The first one is, and obviously, in my opinion, I think the electronic is fine, but I respect your opinion. Number one, when you have that situation, I have two approaches. One is we're having a CPA-prepared audit. What are you looking for that is not covered by that audit? And normally, that's a good way. Having a CPA-prepared financial statement helps with those kind of situations. But second, I would say that the firm I originally worked for was Arthur Andersen. They went out of business because they shredded all kinds of documents that they thought were going to be a problem. Well, it was in a room 40 by 40 by 50. And if they'd have just told the agents, go for it. So my second bit of advice is to print out all that stuff. It would take days and weeks for somebody to go through trying to find some sort of smoking gun, most likely. And so oversupplying information isn't a bad idea either. So those are just two anecdotal, not stepping on the law in any way, of course.
No. Okay, Adam, this one might be for you. So a large management or an association, we normally wait on releasing annual statements until the statements are audited. Historically, that takes us well past the 75-day statutory requirement for release of our statements. So far, this has not been a problem, but do you have any recommendations on how best to rectify this issue and to meet the statutory requirements?
Well, keep in mind, the statute doesn't say that you have to provide audited financial statements, right? And the statute also doesn't say that you have to send out the financial statements within 75 days. It says you just have to make them available to the owners at that time. So there's two ways I think about this, right? You could provide them with the unaudited financials if they ask for them after the 75th day, and then supplement it with the audited, or put an asterisk on it or whatever, big block type. Or you try to work with your auditor to have it so it's ready within 75 days, which may not be practical. I understand that, and it's difficult. But here's what I'd say about it. Members that are going to complain about that, right, are going to complain about a lot of other things. And so, do I think that you've damaged your members if you don't get them audited financials within 75 days, but you allow regular financials to be shared? Absolutely not. And so, because to Chuck's point, the audit is the best, right? It's like good, better, best, right? Between, consolidated review and audit. And so if you're an association that is providing audited financials to your association and you're not required to do that, that is beyond best practices, in my opinion.
I agree with everything you're saying.
Okay, Amy, back to the book. Can you remind us again what needs to be in the book?
Yes, so the book is requiring that you keep a detailed account, and it does need to be in chronological order of basically any documentation of receipts or expenditures that were spent on the repair, maintenance of common elements or other property for which the condo association would be responsible for. And again, this section is specific to the horizontal property regime. So the condo association in South Carolina, there's not an equivalent statute that applies in the context of homeowners associations in South Carolina.
So excellent clarification on the condo versus single family. So the second part of that question was, does CAMS have enough information to compile that book? And I can say, yes, we do. We keep all receipts and we keep all invoices and information that needs to be compiled in the book. To date, I'm not sure if anyone has asked for a book, but that may have to be asked. I'll have to ask that question of others. So Chuck, if your budget is less than $100,000, is it really necessary to have a compilation? And what benefit if you have it in a detailed financial packet, such as the statements we receive from CAMS?
I'll give it to you straight. I wouldn't do one for 100,000 budget or less, and especially if CAMS is managing your association. It's just not cost beneficial. Putting together that financial statement, it's going to be 3-4% of your budget, and it's just not worth it. I mean, unless you have some contentious issue that you want the CPA involved, but it has to be cost beneficial. It's not good for anybody. Enough said, I think.
Excellent. Well, I know we have 3 or 4 more questions. It is after 5:30, so we'll keep answering a couple of the questions. If you need to drop off, thank you for participating. But we'll try and get through these next few questions and see if any more come in. So Amy or Adam, record retention requirements for various documents. And Chuck, maybe you could chime in on that as well. So I know CAI produces a large record retention document, but do you have any comments on items that need to be retained versus items that don't need to be retained?
Let's not everybody jump at once on this one.
Well, yeah, go ahead, Adam.
Yeah, this is a very difficult and challenging question to answer because the number of records that you're required to keep is voluminous, right? And there's certain things that you're required to keep in perpetuity. There's some things that best practice is 7 years, some things that you need to keep for 3 years, right? Like Amy Wooten as a litigator will tell you that most of the time there's a 3-year statute of limitations. However, sometimes if something's signed under seal, it may be a 10-year statute of limitations. So it really depends in terms of the technicality of what it is, right? I mean, so when I generate, and our firm generates a records retention guideline, it's like 6 pages long. And it's based on the IRS's guidelines for nonprofit and tax exempt, because there is nothing in North Carolina that necessarily says that. But let's give an example of something that you should keep for all time, right? Is probably your tax returns, because you could be audited at any time, right? There's no statute of limitations for tax fraud, last I checked.
So one of the 2 little anecdote, because you're exactly right, Adam. I think you should have a policy on some things, a practical policy. One of them I suggest, just based on experience, is something about emails, because attorneys love subpoenaing every email. I've had it happen with me. They want every email I've ever had for X client who's suing somebody else, and we have to go back in our archives or whatever. And having a policy of deleting emails after a year or so, I think is not a bad idea. And but the IRS has as you indicate, has guidelines on it. I as a general rule with tax, it's unlikely, if you're worried about fraud, okay, I'm not sure what to tell you about keeping records. But a normal, honest taxpayer should only have to keep really detailed receipts and copies of checks for about 3 years under normal IRS audit procedures. And only if they suspect fraud, as Adam said, can they go back further. So if you're honest, for a lot of those kind of detailed things, you shouldn't have to keep it more than 3 years or maybe 4.
Okay.
And I would just like to add as a asterisk on the document retention piece is whatever the applicable statute may be, if there is a situation where the association is in litigation and
Oh, yeah.
anticipating litigation, needs to bring litigation, you need to make sure that you're saving documents, whether they're beyond that statutory period or not. And you need to make sure if you've got automatic processes that may run like in your email program to destroy evidence or documents, that those processes have been halted so that you're preserving the information that you need. So just a little asterisk there to be thinking about.
Yeah, certainly agree with that.
Excellent. And we do have a document retention policy document that we can share. So reach out to your manager for that document if you would like to see that, and we're happy to get that to you. So next question, does the annual need to spend 90% of the assessments include the dollar amount being collected for reserves? Can you only put 10% to reserves annually regardless of the identified need to build up the reserve? Chuck.
The reserve assessment is not part of that calculation. So you could reserve more than 10%. I mean, it's not part of the 90%. In other words, the 90% you're spending is based on operating budget. And so the reserve, by definition, is for future capital expenditures. It's outside of that calculation. Does that make sense?
It does.
Okay.
Is bonding of financial managers an insurance requirement? So, and I think that would be, is bonding of the association management company an insurance requirement?
No, I mean, not in North Carolina.
No.
But to Chuck's point, right, when they do their review or audit, they're looking at what kind of insurance coverage you have. And so if you have a management company like CAMS, you're going to ask to see a copy or at least proof of insurance of crime and fidelity insurance. That's the line item that you care about, because that's what protects you if money goes missing. Now, if you're self-managed, you should have your own crime and fidelity policy. And you may, even if you're professionally managed, consider having an additional supplemental policy for crime and fidelity. But there is no requirement right now in North Carolina that you as an association have that kind of insurance. And I see it very rarely be required in the governing documents. But to me, it's like you need liability, you need property casualty, you need D&O, you need fidelity and crime. Like that's just what you have to have.
Okay. If an HOA is part of a master association, what is the financial reporting requirement of the master association to the sub-association?
Totally depends. It depends on the way the master is set up, okay? Because I've had master associations where the individual members of the sub-association are also members of the master association, right? In that case, the sub-association has zero rights to see anything. If the sub-association itself is the actual member, then it may have some rights to get some additional information. But we'd have to see what the documents say. But just because you're a sub-association under a master regime does not mean that that sub-association is entitled to the financial information that a member would be of the master. I've got 2 questions for Chuck that I'll hit here while you're getting that one, Ben. So Chuck, what I would say is this: if an association has an audit conducted and gets an unqualified opinion, is there any reason to have a forensic audit requested?
Oh my God. It's like asking is there any reason to have a policeman come in and look for fraud in your organization? It's a forensic audit. And I always recommend police departments to do forensic audits because they're on the public payroll instead of charging $300 an hour for a forensic audit. It's a totally different thing from an audit, is my point. You have to have really strong evidence of a fraud for some reason to ever ask for a forensic audit. Not to say you wouldn't, of course, but it's a whole different animal. And the fact that you're having a CPA prepared financial statements should give a third party some understanding of the integrity of that organization. They're willing to have an outside independent person look at the big picture and make sure there's nothing, seriously deficient about how they're managing everything.
I appreciate it. And the final question I have for you, Chuck, is when an audit is performed, will the CPA that's performing the audit, let's say for an association that has reserve accounts and they're filing the long form, will you look to make sure that the expenditures are consistent with the IRS regulations in terms of the things that are proper to use that very guarded, protected money on, i.e. make sure they're not using it to cut the grass or paint the clubhouse, things of that nature, or is that out of the scope?
No, that's absolutely within the scope, because it's like having your CPA do your tax return. He will decide most likely whether in a business would decide whether to record something as an asset or a repair. And we have very well-defined standards for that. And for the reserve, number one, it needs to be reserved for. And so you need to have line items or a broad category. And number two, it needs to meet IRS guidelines for a capital expenditure, because you can't have painting in your reserve. That's always an IRS, that's always expense. So that has to be a non-qualified reserve.
So I guess to say that another way, just to tie a bow on it, that if you have an audit, if your association has an audit conducted, that it is a fair statement to say that the auditor has ensured that your expenditures are consistent with the IRS code and regulations for those protected capital reserve accounts.
Yes, and we usually underscore it by disclosing in the reserve footnote what they spent it on.
Perfect, thank you.
Okay, I'm going to paraphrase this next question. It's a long one. So the community has seen a significant increase in an attorney litigation line item. The treasurer has cited attorney-client privilege when it comes to sharing of invoices to a group of owners that are requesting to see them. Are the owners entitled to see those invoices that are in question?
The answer is it's a hard no. Okay, the owners are entitled to know the amount of money spent on the attorney, but the members are not. I would argue that members aren't entitled to see invoices of anything anyway, right? But you certainly are not entitled to legal invoices because they are attorney-client privilege, and the board of directors carries the privilege for the association. If you're to share that attorney-client privilege information with the members, what you have done, and Amy, correct me if I'm wrong, is essentially waive attorney-client privilege with regards to the subject matter of those entries listed on the invoices.
And I would underscore that the only audit procedure at all related to that is as part of a standard audit procedure. If there are legal bills, we're required to request a confirmation from the law firm that there aren't any pending actions that based on their current judgment would have a material impact on the financial statements. Now, we are not allowed, for obvious reasons, to disclose details of any of that. It would be very carefully, wording would be lifted from the attorney letter. But so an audit would look at the general concept.
And then it's for that reason that our bills, our invoices, we have a cover page which has the amount due, any past amounts due, and then year to date spent on the cover page. Because we know associations, if the board decides, they can share that information with the members, but it's just the cover page, right? And, you know, transparency is the key with all of this, but unfortunately, members sometimes have a difficult time understanding that the way that their association is set up, it doesn't necessarily mean that they're entitled to everything that the board is entitled to. And that's one of those things they're just not entitled to.
And I think you've seen that there tends to be a lot of confusion in the homeowners association, community association space, that the association's attorney represents all of the members or owners. And that's just not the case. We represent the corporate entity, the association. And so I think that's where a lot of that confusion stems from, in terms of folks thinking they're entitled to more information or records than perhaps they really are.
Okay. Well, two last questions. One quick one, one maybe a little longer, but so how long is CAMS record retention for financial records? So we have different guidelines around different documents, but the financial portion, just the financial balance sheet, income statement, I think is permanent. Receipts, invoices, and other items are either 3 or 7 years, and I'd have to look at specifics. But so different documents have a different retention, guidance. So again, we can share that document if you have questions on that. Last question: should D&O coverage limits exceed our board members' net worth? Adam.
Well, first of all, I think you're going to find it challenging to find D&O policies for nonprofit corporations that are going to reach the level of all of your board members' net worth. And so really and the reason I say that is most D&O policies will not be written for more than $1 million you'll have to go out of market to find some that'll go bigger, right? And so what is D&O? Okay, just to explain why it's not really related to the net worth, is that in North Carolina, you have immunity from liability serving as a volunteer on a nonprofit board, as long as you fulfill your fiduciary duties of good faith, due care, and loyalty. Your governing documents for your homeowner association are also, as well as the statutes, providing you with what's called indemnification, which means that if you get sued and have to pay money out of pocket, the association is required to reimburse you for that. Now, I know that's cold comfort, especially if your association isn't keeping enough reserves and they don't have any money to pay you back. But that's the reason for director and officer liability insurance, because it pays for the cost of defense. Keep in mind, D&O liability is not necessarily there to pay for any personal liability of a board member on the back end. It's to pay for their defense of the lawsuit. So their net worth really has nothing to do with it. And Amy, before she went into private practice with us, actually worked on the other side with the insurance companies in terms of figuring out what was going to be covered, what wasn't, things of this nature in terms of willful gross negligence. But the point is this: if you do something bad as a board member, let's say you punch somebody out in a meeting, there is no insurance that's going to protect you from that. If you decide not to get an audit and your documents require to get an audit, there is no insurance that you can buy to protect you from that, right? So it's really about how much you need to get the lawyer to defend you. So net worth has nothing to do with it. Now, if you're a board member and you're worried about there's not adequate insurance coverage for you serving on the board, you can go to your private insurance company and you can get something on your homeowner's policy to kind of supplement it. But my advice is, if you're worried about it and that's what you're thinking about and you're scared, then don't be on the board, right? As Chuck said at the beginning, you all are volunteers, you all have big hearts, you all care about your community. But if you're worried about liability, then don't put yourself in that position, because that's what the D&O is for.
Well, excellent. Thank you very much. Those are all the questions. We almost got through 20 minutes. Thank you for those of you that have stayed on. Looks like we have about 55 individuals still with us. So great topics today, great questions. We enjoy hosting these and we enjoy having you join us. So Chuck, Amy, Adam, and Eric, we didn't get to hear from you, but we do appreciate your involvement today. So as a reminder, we do record these sessions. They are posted on the camsmgt.com website. They are there for your viewing pleasure. And we hope you will share this information with your other board members because it's a lot of important things to learn. So we look forward to seeing you for the next session. We hold these the third Thursday of the month. So thank you, and we'll see you next time. So thanks all.
Thanks so much.
Thank you.
Appreciate it.